Hey, welcome back to the channel, everybody. Today I'll be going over two different companies where insiders have been buying shares for the month of October. The two companies that we'll be discussing today are designers and manufacturers, but are in completely different markets. One of the companies pays a 2% dividend, while the other one pays a 4% dividend. So this should be really entertaining and a valuable video to you. If this is the first time you have watched one of my videos, thanks for being here. My name is Justin, and this month marks 2 years on YouTube for me. My background is in accounting and in finance. I have managed accounting departments in various industries such as aerospace, oil and gas, and renewable energy. I have a strong passion for investing and analyzing companies and sharing them with you. I took Phil Town's investing course a couple of years ago, which shaped a lot of my investing strategies and my investing philosophy. One thing I learned from the course is the importance of insider buys. After all, insiders know the business better than anyone else, and insider buys could indicate the stock is undervalued and there may be near-term tailwinds that management knows about that we may not know about. Insider buys don't always mean the stock is going to go up, but it's definitely something that gets my attention when it happens. If you like these type of videos and you get value out of them, go ahead and hit that like button. It really helps out the channel a lot, and I personally appreciate it. Okay, so let's discuss the first company, and this one is in the outdoor and leisure space. The company is THOR Industries, ticker symbol THO. THOR Industries designs, manufactures, and sells recreational vehicles. They are most known for their RVs, such as their diesel Class A, Class B, and Class C motorhomes. They manufacture travel trailers as well. The company provides its products through independent and non-franchise dealers. The company is based in Indiana and was founded back in 1980. THOR Industries is very cyclical, and the stock price definitely reflects this. With any type of cyclical business, investors want to get in at the bottom and sell at the top. THOR's bull run actually started back in 2017, where there was a shortage of RVs on the market. The business really picked up around that time frame. Then we saw a huge need in outdoor equipment in 2020 during the pandemic, when a lot of things were shut down, but people still wanted to travel. Companies that made recreational vehicles like THOR saw massive spikes in revenue and profits in 2020 and 2021. THOR Industries is in a unique position because they can control a lot of the pricing in the market due to their market share. They own about 45% of motorized sales and 40% of towable sales in North America alone. This market share allows them to control their margins more than other manufacturers in other industries. For the month of October, one of their directors bought THOR stock, indicating that the bull run may not be quite over just yet. If we take a look at the company's balance sheet, we can see they have about $300 million in cash, about $1.4 billion in net debt, and $1.3 billion in working capital. The balance sheet is very solid overall, in my opinion. If we turn to their income statement, we can see revenue growth about 17% per year over the last 5 years, and earnings per share growth of around 23% per year during that same time frame. Much of that growth was in the last 2 years as RV sales really took off. Analysts, however, are bearish on this company moving forward. They predict revenue is going to fall into the negative 12% CAGR range over the next 3 years, while earnings per share is going to crater even further, around negative 25% per year during that same time frame. This has pushed the stock down about 30% year to date and is now trading around $78. Currently, the company is paying $1.72 per share annually, which calculates to a 2.2% dividend yield. The company is a strong dividend payer with more than 10% dividend growth over the past 10 years. The payout ratio of only 8% is incredibly low and indicates the company can easily pay their dividend going forward. If we turn to valuation, the company is currently trading below a 4 PE, which is insanely low, especially compared to historical trends. Book value per share is also very low, coming in at below 1, which is the lowest valuation over the past several years. However, the forward PE is coming in higher than the historical trend, which is coming in around an 8. The forward P clearly indicates analysts are not optimistic about the near-term future for THOR Industries. There are certainly risks to be considered with THOR. For one, the 2020 pandemic really catapulted the company's top-line growth. Many of the folks that may have decided to buy an RV, say later on down the road, bought them in 2020 and 2021. This likely means revenue peaked in 2021 and we will see it go down over the next year or two. In addition, the economy is starting to hurt with interest rates going up, so that could mean potential buyers may get priced out of the RV market. Also, THOR Industries is in a cyclical market, so there are very high highs and very low lows. The bull cycle has been running strong for the last few years for this company, so does that mean it is about to end? Analysts certainly think so, but with insiders buying the stock, maybe they are wrong. The company boasts a solid balance sheet, so they should be able to weather any type of macroeconomic issue. Definitely a stock to keep on the watch list in my opinion. Now, the second company that I'm going to discuss here is a designer and a manufacturer of furniture. The company is called MillerKnoll, ticker symbol MLKN. MillerKnoll was formed back in July 2021 when two companies, Herman Miller and Knoll, merged together, combining some of the best brands into one umbrella and under one company. The newly merged company offers brands such as DWR, Herman Miller, and Hay. The company operates 70 retail studios under multiple names such as Herman Miller and Knoll. The company was originally founded back in 1905 and is headquartered in Michigan. The merger created a lot of uncertainty, and markets just don't like uncertainty. Investors want to easily forecast growth numbers, and when a company merges, that can be very difficult. This often hurts the share price, as many investors are not willing to put the time in or don't know how to value the new business. We have seen that in a lot of other companies, such as Warner Brothers Discovery that was formed in April. Sometimes these can be great opportunities for investors to buy at a discount. In the best case scenario, an investor buys a discount knowing the opportunity, and when the market finally sees that same opportunity, the stock makes a lot of gains very quickly. So it pays to get in early. So let's dig into this company further and take a look at the financials. Keep in mind the historical numbers are pre-merger, so they are not super helpful, but we'll still talk about them anyway. The balance sheet is solid with cash coming in around $200 million. Net debt is currently around $1.2 billion and working capital is $440 million. The company did take on debt during the merger, so that is something to consider. The balance sheet is still in a good place, but the long-term debt did grow about $1 billion, so the company will need to focus on deleveraging going into the future. The income statement shows top-line growth of around 11% per year over the last 5 years, but EPS has been around -2% CAGR. Again, this is pre-merger, so not something to hang your hat on. Analysts are optimistic about the future, with revenue expected to grow around 7% per year over the next 4 years, while EPS is expected to grow around 30% per year. Keep in mind that the bottom line growth should be impressive with both companies now under one umbrella. Unlike THOR Industries, who saw massive upswings in revenue during the pandemic, many of the furniture stores were not as fortunate. Currently, the company's stock is trading around $17 per share, but is down 55% year to date. That's right, 55% compared to the S&P 500, which is down around 25% year to date. The valuation metrics for MillerKnoll are very interesting to say the least. The current P of 22 does not look very attractive, but the book value per share of less than 1 is outstanding. Also, the forward P of 8 is incredibly low for the industry on a historical basis. Not only that, but the company boasts a 4.3% dividend yield. However, the payout ratio of 70% is concerning from my standpoint. The company's cash flow has taken a beating over the past few quarters, so in my opinion, the current dividend is not safe unless the company can turn around their free cash flow situation long term. Last quarter, they paid out around $14 million in dividends, so the company can theoretically keep pulling from their cash to pay their dividend over the next few quarters and possibly be okay. However, at the present cash burn rate, their cash will run out in the next 12 to 15 months from my calculation. Now, this has not prevented insiders from buying the stock. In fact, the president has been buying shares in October, which is reassuring if you are a current shareholder or looking at buying some shares of this company. However, let's talk about some of the risks that I see with this particular investment. Like I mentioned earlier, it can be difficult to value a company that recently went through a merger like MillerKnoll did. The historical data isn't useless, but not as meaningful. Valuation metrics such as PE, EV over EBIT, book value per share, and so on work much better when you have 5+ years of comparison data to look at. You don't get that with the merger. Also, furniture is a discretionary item. During a recession, people are not looking to buy new furniture. They are making sure they can just pay their necessities like shelter, food, and utilities. If we go into a deep recession, MillerKnoll could suffer on the top and bottom line. If that were to happen, I could see the dividend get cut in half, or worst case scenario, could be cut altogether, which could push the stock down further. And finally, furniture companies are typically difficult to invest in due to their cyclical nature. The great Warren Buffett, the best investor of all time in my opinion, has bought multiple furniture companies in the past, and I can't think of one that actually worked out. If you can think of one, drop it down in the comment section below. I know he currently owns RH right now, and he has done well so far, but he hasn't owned it for even 3 years yet, so that is an incomplete in my opinion. So those are the two dividend stocks that I really want to talk about today that insiders are buying up. So what do you think about THOR Industries? What do you think about MillerKnoll? Do either sound interesting to you? Drop a comment down below. If you're interested in learning and how to value companies and being part of my Discord channel, I'll have a link to my Patreon down below. Go check that out. Thanks for watching, and don't forget the like button and subscribe on the way out. Have a wonderful day. God bless, and I will catch you on the other side. Take care.